From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome now to Balance of Power. We start with a check on the markets. Joining us today is Abigail Doolittle. So, Abigail, it looks like it's about tech today. I don't see much going on with the 10-year, but the tech seems to be rising.
Yeah, we do have some strength for tech, but mainly, David, at this point, we actually have mixed markets. The S&P 500 and the Dow down slightly, the tech-heavy index up slightly. So this is a continuation, this mixed action of last week's declines for stocks. Last week, despite the fact that Thursday and Friday were strong, it was the worst week since February. So some of that uncertainty is still coming through, especially for Bitcoin. Bitcoin now at $43,000 per Bitcoin amid some commentary out of China, plus just the idea of too far, too fast, frothy. From an individual stock standpoint, David, lots of news for the big banks. Of course, JP Morgan, lots of changes at the C-suite. Daniel Pinto at the end of the year will be the sole president and COO, while Marianne Lake and Jen Pipsack will co-head the consumer unit. Bank of America raising their minimum wage to $25 per share. Even so, or $25 per hour, I should say. I'm always thinking in stocks, David. Even so, you can see both of those stocks down ever so slightly. And then, of course, retailers, lots of positive retail reports out as stimulus hits the American consumer who have been out there shopping. So lots of positive reaction there for the most part from the likes of Walmart and Macy's. Home Depot had been higher earlier, now a little bit lower because that company, David, actually won't say how much of the recent strength had to do with the stimulus. So there's some fear that it could be short-lived. But net on the day, a bit mixed.
Yeah, and a pretty good story for retail. But let me ask you, one other thing was the dollar. The dollar's weaker today. I saw some accounts that said maybe concerns about inflation were holding the dollar back.
Well, the dollar is really interesting because it is very close to make or break support. If it can hold current levels, that would actually be a positive, I believe, for the reflation story. The idea that this transitory, what's being called a transitory price rise in prices will actually turn out to be reflation because the market will absorb it and everything will go along. And this is just growing pains. On the other hand, if the dollar falls apart, that might not be so great. That may suggest that there could be some inflationary concerns. But today, the dollar is down, but right now, holding support just by a thread, David.
Okay, thank you so much to Abigail Doolittle for that report on the markets. President Biden came to office focused largely on fighting the coronavirus and restoring the economy. But as often happens, geopolitical issues crowd in, whether it's violent conflict in Israel, cyber attacks on infrastructure from actors in Russia, or coming to terms with an emergent China. Jane Harman has spent her career addressing issues like these as a long-term congresswoman from California who served as the ranking member of the House Intelligence Committee and is the president of the Woodrow Wilson Center. She is now president Emerita, and she's really written a new book out just today summarizing her lessons, good and bad, from her dealing with foreign affairs. It's called Insanity Defense, and we welcome now Jane Harman back to Bloomberg. So, Jane, thank you so much. Congratulations on your new book, Insanity Defense. I guess it's because if you keep doing the same thing, expect a different result, you're insane.
Exactly. You don't get a new result. That's the point. And in the last 30 years since the Cold War ended, we keep doing the same things. And we're doing the same things in the Middle East, too, which is obviously top of news today. But there may be a way forward. At any rate, there are very hard problems. To solve them, we need a White House that wants to solve them, and we need a Congress that wants to solve them. The latter may be missing.
Well, let's talk about this specifically with respect to the Middle East. You mentioned that. We've seen this violent conflict going on. Not the first time we've seen it between the Palestinians in Gaza and Israel. At the same time, where is Congress in this process? Because I know one of the things you cover in your book is the fact that Congress's role in foreign policy, if anything, has been diminished over the years.
And Congress has diminished its own role. You can't blame other folks for this. But Congress is not speaking with one voice or even two voices. There are letters from the left about how apartheid is happening. I assume there are conversations with President Biden in the center. And then from the right, there's total criticism of everything Biden's doing. So that's certainly not one voice. It's at least three voices. And this is, to me, approximately, I mean, maybe it will be called this, the third intifada between Israel and Palestine. All those years, we tried to forge a two-state solution when the parties on the ground didn't want it as much as we did. That's insanity. Let's just go there. But now it's much harder for several reasons. Number one, Bibi Netanyahu is kind of in between prime ministerships. 4 elections have in the last year have not produced a majority for his party. And by the way, a few months ago, as I remember, he was trying to bring the Israeli Arabs into his coalition. Now they're basically against him, given this recent development. But at any rate, he's in between elections. Someone else has been asked to form the government. If a new government is formed and he's not in it, he's subject to severe penalties if he's convicted of corruption and could go to jail. So it's top of mind for him to basically blow up the coalition against him with this activity. And he's done that extremely effectively, and he may survive this. So there's one. Number two, Hamas has been a problem for years. It's a terrorist organization. It capitalizes on the tunnels underneath Gaza, underneath commercial buildings, which is why it's so hard to obliterate those tunnels without torching Gaza. It's very difficult. And Hamas has a poor relationship with Mahmoud Abbas, who's the head of the Palestinian Authority in the West Bank, and who just delayed elections because the polls showed that Hamas might gain on them. So I'm just saying this problem is much harder than it was. And with Congress AWOL, lots of experienced people in Congress, as I was, who know this story very well. So does Joe Biden personally, because he was in Congress for so long. It makes it much harder for the U.S. to figure out how to help with a way forward.
Jane, let's take up another challenge we're facing right now in the United States, and that's cyber attacks on infrastructure. We had the Colonial Pipeline situation last week. It turns out that's one of almost 400 such attacks over the last year or so. It's not the first time. In your book, Insanity Defense, you talk specifically about the events leading up to 9/11 and the fact that there were various attacks that if we put it together the right way, we would have known something was coming. Are we potentially facing another big one with respect to our infrastructure here in the United States?
A lot of people talk about a cyber 9/11. I think it is possible. But I also think that this series of attacks in many ways is as deadly. I mean, let's look at Colonial Pipeline. They basically shut down fuel supplies for the East Coast for a week. And getting them back up is hard. Gas prices are up. I mean, maybe we're in for inflation anyway. But this was a ransomware attack. On their IT, on their software systems, where they get paid and pay people and all that. But to be extra careful, they shut down everything. And if we're having that on a regular basis, and not just in the US, but all over the world by criminal syndicates, many of them based in Eastern Europe and Russia, we're in for a pack of trouble. Are we prepared? Not adequately. The Biden administration, to its credit, now is naming someone to be the cyber czar in the White House. Actually, Congress mandated that. Chalk up one for Congress. Yeah. And it has beefed up the capacity of the Homeland Security Department to deal with cyber. Trump, to remind, fired a very capable guy named Chris Krebs, who was in charge of the cyber piece of the Homeland Department, because he said that there was no interference in the election machinery by outside foreign governments.
So let's come back to this theme about the role of Congress versus the role of the executive branch. When it comes to something like really hardening our infrastructure process, is that essentially an executive branch function, or are there things Congress could do to help harden that infrastructure?
Oh, you bet. I mean, there are some things the executive branch can do. The Homeland Department can declare various parts of our infrastructure critical infrastructure. That means federal funds can flow to harden those things. And I'm sure that's going to happen. Biden issued an executive order last week that mandates that facilities that do business with the federal government, if they are subject to a ransomware attack, have to notify immediately. But there are two qualifiers in there. One is ransomware, and the other is if they do business with the federal government. A lot of facilities don't do business directly with the federal government. Congress, on the other hand, could pass a much more comprehensive law, and I know many in Congress are suggesting this, not only to declare a range of things, critical infrastructure, but to appropriate more money to protect them. Congress is the one with the purse strings, not the executive branch. advantage.
Jane, finally, let me sneak in one more because there have been some headlines crossing the Bloomberg even as we've been speaking. They come in regards to the Iran nuclear talks. And the Russian envoy to those has been talking actually to the BBC Persian service and has said that they've made significant progress and that they're expecting maybe a big announcement, an important announcement tomorrow. What is your take on what's going on with the Iranian deal?
I actually applaud this. And I think one other signal that something is happening is the fact that Hezbollah, which is another Iranian proxy along the Lebanese border with Israel, hasn't unleashed the 100,000 rockets that it has put there under civilian housing. The Lebanese people are shields again. And they haven't unleashed them. Just a few have gotten out. Why? Because I think they're hoping that something will happen. Let's understand that there aren't just sticks in this world, there are carrots. And Bloomberg understands this, that if we can find a way forward with Iran, that would not only get them to certainly contain or stop their nuclear program, but also contain or stop their proxy terror groups, we'd be in a much better place. And it will take a coalition to get this done. Russia and China were in the P5+1 that struck the prior deal with Iran. And I think, maybe I'm not really Pollyanna here. I see this Israel mess pretty clearly. But I think there are other opportunities in the Middle East working with allies, which will permit President Biden to keep his eye on our top threats at home, which are domestic terrorism, climate, the pandemic, and building back better an economy. And his foreign policy includes these things. And if he's in Michigan today, focusing on infrastructure. So I think he's got this thing in pretty good balance for the moment. But keep reporting on it, David. It's tricky.
It is tricky indeed.
A hard problem.
No question. Whenever you're dealing with Persia, it gets tricky, I think, in my experience. Thanks so much to Jane Harman.
Thank you, David.
She's president emerita of the Woodrow Wilson Center and author of the new book, Insanity Defense, Why Our Failure to Confront Hard National Security Problems Makes Us Less Safe. Coming up, getting our arms around cryptocurrencies with Republican Congressman from Ohio, Warren Davidson. That's coming up next on Balance of Power on Bloomberg Television and Radio. We have breaking news now. Robinhood is reportedly planning to reveal its IPO filing as soon as next week. The trading app is said to be targeting the end of June to go public. And now we turn to Bloomberg First Word News, and for that, it is Mark Crumpton.
David, thank you very much. Following up on what you and Congresswoman Harman were discussing, shippers on the Colonial Pipeline say they can access the pipeline communication system. The framework allows customers to enter and make changes to their batches of fuel traveling through the system. The Colonial system resumed service May 12th after a ransomware attack shut down the entire system 2 weeks ago. Colonial says it's having network issues. President Biden's infrastructure proposal includes billions to improving cybersecurity. It's an area of intensified interest after that ransomware attack on the Colonial Pipeline. The $2 trillion American Jobs Plan includes $20 billion for state, local, and tribal governments to modernize their energy systems and $2 billion for grid resilience in high-risk areas. That's according to a fact sheet obtained by Bloomberg News ahead of its release today. European Union foreign ministers are debating how to use the 27-nation bloc's political clout for help to end the fighting between Israelis and Palestinians. The EU has called for a ceasefire and the need for a political solution to end the latest conflict. But the nations are divided over how best to help. The EU is the biggest donor of aid to the Palestinians, but holds little influence over Israel or the militant group Hamas. Bank of America will raise its minimum wage to $25 an hour to make it easier to attract and retain employees. B of A's current minimum is $20 an hour. The $25 wage will kick in by 2025. The bank also will require its U.S. vendors to pay employees assigned to the bank $15 an hour or more. Global news 24 hours a day on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. Cryptocurrency is in the news just about every day, whether it's the extreme volatility, Elon Musk going back and forth on whether to take it as payment for Teslas, or criminals demanding it in ransomware. Republican Congressman from Ohio, Warren Davidson, has become something of an expert in cryptocurrency policy, and we welcome him now to Bloomberg. So, Congressman, thank you so much for joining us. You have really gone out in front on cryptocurrency. Give us your attitude toward cryptocurrency and specifically whether and how it should be regulated.
Well, one of the most important things is that we get a clear definition for what is and what is not a security. You know, if you remember back to 2017, 2018, there were a lot of ICOs, initial coin offerings. And this was essentially a regulatory arbitrage thing where companies were trying to essentially launch a security. But lots of things were trying to just get an idea out there, and they're clearly not securities. This has been one of the hangups at the SEC, and I think it's one of the biggest opportunities for Chairman Gensler to really provide clarity for our markets. But really, this is Congress's job. We should pass this law. This is part of a really bipartisan bill, the Token Taxonomy Act, that Darren Soto from Florida and I introduced in 2018. So we've continued to work on it. That's one of the biggest things. The other big thing is custody. So one of who has custody of the crypto. And this lack of clarity on that piece is a big part of why normal retirement funds haven't been able to offer crypto. And this has been the best performing asset class over the past decade. So it's really consequential that your average retiree or saver hasn't had access to this directly in their retirement portfolio. So I think the last thing is tax consequences.
Yeah, exactly. Because you would give something of a tax break, right, to appreciation of crypto?
Yeah, just the same as you do for regular currency. So, I'm not for redefining the whole regulatory framework, at least initially. It's just let's apply what already applies to other currencies.
So let me ask, if it's not a security, does CFTC regulate it? And regulation seems to be important. I mean, actually, Bitcoin is down substantially today because China has reiterated its position. It doesn't want its people trading in crypto.
Well, it doesn't want people trading in something else that China doesn't control. So China's an authoritarian regime, and they're in the process of launching a central bank digital currency. So it'll behave a lot like, Bitcoin would, except that it's completely opposite. It'll have the central authority, the Chinese Communist Party, controlling all of the behavior of it. So they'll be able to literally monitor every individual's transactions, and they'll be able to link it to their other data to essentially establish a social credit score. Not just an ability to repay, but are you being a good citizen in the eyes of the Chinese Communist Party? So it's really a system of control, not a real monetary system in the sense of store of value, means of exchange.
Congressman, cryptocurrency is figured largely in the ransomware demands on some of the attacks on infrastructure. It's not clear to me how a ransomware would work if it didn't have the pseudonymity of cryptocurrency. Is there any way to make sure we still have cryptocurrency, but it isn't used for really illegal purposes? Certainly ransomware, but others as well.
Yeah, and I think this is why it's important that U.S. Treasury gets after things like, there's a company, Chainalysis, is one of the early movers in this space. But if you truly wanted to be, private, you wouldn't put it on the chain. You wouldn't put it on a public ledger.
Congressman, if in fact there's regulation that goes forward, does the CFTC do it?
Well, the CFTC is the primary regulator for Bitcoin and Ethereum. There hasn't been a clear ruling on other crypto products. And look, everyone thinks about the payment systems, but the broader architecture, blockchain, is going to be dynamic just like the internet. I mean, we're 30 years into the internet, and we haven't even begun to tap all the use cases. So we're in the infancy of the blockchain architecture, and it truly is a different architecture, a different way to establish trust in a much more secure way.
You're on the Financial Services Committee. We just had word that Robinhood looks to disclose their plans on going public next week. Maybe by the end of June they'd go public. Do you have any initial thoughts about Robinhood going public?
I'm excited because I think the earlier stage, a company that is mature, Robinhood's proven its value. It's proven its resiliency in the face of some market dynamic changes. So kind of the venture capitalists and private funds got it bootstrapped up to this point. And look, the United States has the best capital markets in the world. I think this is a great opportunity. We'll see how it's priced as to whether, it's a good price for the stock or not. That's for the market to decide. But I think, more people can participate in the ownership of this company. And it really is a transformative idea. Really, the whole spirit of the name and everything else is more democratic access to capital. And that's emblematic of what we should be doing with our capital markets. You know, average, ordinary investors ought to be able to have the kind of access to capital that the Wall Street insiders do. And the recent news about Robinhood has really drawn that into the discussion.
Congressman, thank you so much for being with us. I hope you'll come back and talk about One Belt, One Road, because we have a lot to talk about there as well with China. That is Representative Warren Davidson. He's Republican of Ohio. This is Balance of Power on Bloomberg Television and on radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. News of the Discovery deal for AT&T's media assets yesterday is followed today with word that Amazon is in talks to buy MGM. It's our stock of the hour, and Dave Wilson is here for a report. Dave?
Yeah, thanks, David. I mean, Metro-Goldwyn-Mayer, that's what we're talking about here. The movie studio that was responsible for the James Bond movies, the Rocky franchises, and so on. You know, the reports in the information in Variety say that, you know, indeed, Amazon.com is going after MGM. In fact, Variety talking about a $9 billion price tag. And you can understand why Amazon would want to bring in the likes of MGM. I mean, they have a lot of competition for their Amazon Prime video service. You know, it's expensive to produce programming, as you can see there, but just all these companies, right? You've got Netflix, Hulu, Disney Plus, Paramount Plus, Peacock, HBO Max, Discovery Plus, Apple TV, YouTube TV, so much competition in streaming. And then beyond that, I mean, just they've got to find a way to kind of bring people in, you know, at a time when you have all this competition, which a lot of it has just kind of come up in the last couple of years. We should note, though, there's one big difference between Amazon Prime Video and the rest of those services. It doesn't have to stand or fall on its own merits. You see the revenue breakdown for Amazon. It's not much in the way of video revenue. So it's more of an attraction to bring people into Amazon Prime and get subscriptions so they don't have to worry about shipping costs for online orders, that sort of thing. So you have to wonder when you put it all together whether this deal, assuming it does happen, gives people perhaps a reason to take a closer look at big tech. Yet again, you know, we've certainly seen that happen in Washington, you know, with Senators Amy Klobuchar and Mike Lee getting together and focusing on antitrust issues. And you know, here we are with another situation that potentially may raise those concerns again.
Yeah, it may not be the last time either. Thanks so much to Bloomberg's Dave Wilson. Coming up, retail on the march. We get a report from Emma Chandra. This is Bloomberg. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. For Bloomberg First Word News, we go now to Mark Crumpton.
David, thank you very much. More trouble for the nation's biggest fuel system. Colonial Pipeline says it's experiencing network issues that are leaving customers unable to access their fuel shipments. Colonial says it's working to restore service. The company resumed pipeline service on May 12th after a ransomware attack shut down the entire system 2 weeks ago. The pipeline appears to still be operating despite the communication outage. Urban areas are doing a better job of getting people vaccinated against COVID-19 than rural areas. That's according to a report out today by the Centers for Disease Control and Prevention. Overall, adult vaccination coverage was 38.9% in rural counties and 45.7% in urban counties. The report also found those in rural communities have limited access to intensive care and are at greater risk for severe COVID illness or death. States are reacting to CDC guidance on wearing masks in various ways. New York State will end its wide-ranging mask mandate for people with vaccinations tomorrow. Masks will still be required on public transit and in schools. New Jersey is sticking to indoor mask mandates for fully vaccinated people, and California won't drop its indoor mask mandate until June 15th. It's JP Morgan's largest management reshuffle in years. Marianne Lake and Jennifer Piepsack have been named co-heads of consumer and community banking. That puts them a step closer to potentially succeeding Jamie Dimon as CEO of the nation's largest bank. Meantime, Gordon Smith will retire as co-president and co-chief operating officer. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Thank you so much, Mark. Macy's, Home Depot, and Walmart all came in with strong earnings today and took up their guidance. Here to take us through it is our retail guru, and she is, of course, Emma Chandra. So, Emma, what are we seeing in retail?
Thanks very much, David. What a title. All of those names, as you said, having a pretty good day in terms of the figures that they put out there, and all of them beating on that key retail metric of same-store sales, something I talk about all the time. Though what we heard from the company is not really being reflected or not really being rewarded in the market at the moment. We're still looking at Walmart in the green, and same too for Macy's, but only just. Home Depot, though, being punished a little, and I think that is down to the fact that they said that sales boost that they saw very much a product of those stimulus checks, and they also failed to offer any updated guidance, and that is something that we saw both Macy's and Walmart do, and of course they will have benefited from that stimulus cash too. Walmart, interestingly, going so far as to say, we don't normally update guidance at this part of the year, but we really wanted to be, as they said, clear with investors. And investors in Walmart really clearly very impressed, not least because of that strong sales in the first quarter, because of the comparisons with a year ago when we saw a lot of stockpiling. Remember, of course, that the largest part of Walmart's business is its grocery. They're also impressed with that changing shape of the balance sheet at Walmart, and we're seeing that in the sense of what's happening with e-commerce. It is a growing business, but really growing pretty rapidly in the first quarter. It saw a gain of some 37%, David.
Exactly. We're talking a lot about base effects these days, but it was thought going into this that maybe Walmart, and to some extent maybe Home Depot as well, would have those fighting against it. And in fact, they did perfectly well, even with the really strong sales last year. At the same time, we're talking about three very different entities, right? A department store in Macy's and a Home Depot that's for home improvement, and we've got Walmart. What does it tell us that all three of those did so well, particularly as you're about to get ready to interview the CEO of Macy's?
I am, yes. Lots of questions for Jeff Gannett later this afternoon. I think what it tells us is really we are seeing a very strong consumer, and perhaps a consumer who is feeling very confident to go out and spend. Certainly we heard on the earnings call from Jeff Gannett that he hadn't expected the pace of vaccinations that we've seen in the US, and for that to have such a material impact on the business. Clearly people, if they've had their vaccinations, feeling more confident, able to go out and shop. Also citing the return of travel. They're seeing lots of people going out and buying more suitcases, which also speaks, of course, to that confidence. He did say, though, he's a bit unsure about international travel. Probably won't come back until about 2022, and that is interesting for Macy's, because about 4% of their revenues do come from those international travelers who, of course, flock to New York and to Herald Square, and, of course, Bloomingdale's just round the corner from the Bloomberg office as well, because Macy's owns them too.
Yeah, we hope they'll come flocking back because they've been gone for a while. Thank you so much to Bloomberg's Emma Chandra reporting on retail. Emma, as she just mentioned, will be speaking to Macy's CEO Jeff Gannett. That's coming up at 3 p.m. Eastern Time here on Bloomberg. For a view from the retail industry itself, we welcome now Matthew Shay. He is president of the National Retail Federation. So welcome. Great to have you here. It looks like it's all coming up roses right now.
Well, I think what we're seeing is the impact of all this pent-up demand and all the stimulus that's in there. Consumers have not been able to put money in certain categories because some parts of the economy were not fully reopened. And so they've got savings sitting on the side. You and I talked a little bit ago about that $2.5 trillion sitting in bank accounts or paying down debt, consumer credit debt, things like that. So consumers across the board, and we have to recognize still millions of Americans, unemployed families that are not doing as well as we'd like them to do. But in the aggregate, the American consumer is very healthy, and you're seeing that come to play. I think, as you and Emma just discussed, the noteworthy thing here is we're going against really tough comps from this time last year when people really were stockpiling in March and April, and still beating those on a year-over-year basis. That's really impressive performance.
What do your members think about what's coming down the pike? Because we hear a lot of talk about a lot of money sitting in the balance sheets of households. There may be a lot of money that hasn't been spent yet, actually. People are talking 2.5, even $3 trillion.
Yeah, I think that's the thing that as we go back to some of our pre-pandemic behavior, how are consumers going to take that pent-up demand, those savings, and the things that they've been accruing and put that to work in the economy? And what's the balance going to be like between goods and services, or between sort of the durable things or the consumer products and the service economy? And I think that's where we'll see retailers really be able to demonstrate the way they've evolved and meet the new needs and expectations of customers in this digital, this virtual world, delivering things in a blended hybrid way, giving them new services, making things more convenient, whether that's in payments or fulfillment or logistics or the way in which they connect socially and in a digital world. I think that's where we're going to see what the next phase of retail really looks like, this renaissance as we come out of the pandemic. I think that's really exciting.
Matthew, do you have a general sense of where we are in that renaissance? Because for the longest time, it was all, let's be frank about Amazon, everybody buying things online. And then you saw really Walmart step up and make some big acquisitions, move into it. And increasingly, we're seeing retailer after retailer really beefing up and making huge strides in their online. Do you have a sense, are we 25% of the way, 50%, 70% of the way? How far are we in that renaissance, as you call it?
Yeah, well, I heard someone say this recently, and say maybe we're in the third inning or the fourth inning. But the way one bit of a little data point or some context, David, if we went back to the recession 10 years ago in 2009 and 10, in each of those years, we averaged more than 400 retail bankruptcies in each year. So over the 3 years, it was almost 1,000 bankruptcies in retail. Over the course of 2020, that number was only about 50 or 60. The overwhelming majority of those were restructurings, not liquidations. So the industry is healthier than it was a decade ago. Consumers are healthier. And I don't think we can overstate the impact of the 2017 Tax Reform Act, which made it possible for retailers who paid at the highest corporate rate, more than 35%, to take some of those savings when the rate was lower to 21% and reinvest that in their businesses. I think that's one of the real reasons we didn't see more failures this last year, because retailers got healthier. They made smart investments. They're ready to meet consumers where they are as we go into this next phase.
One of the things we hear a lot about is not just how much money is in the system, but also the possibility of inflation. Are there some cost pressures that are showing up for retailers, whether it's labor costs, whether it's input costs, the cost of goods, and can they pass those along?
Well, I think certainly we're going to start seeing input costs, and we've seen shortages. A year ago, there were stockouts for different reasons because consumers were hoarding, but now we've seen things change to the point that we know all kinds of input goods are in short supply, and so businesses are out there trying to find the things they need to serve their customers in different ways. I think that remains to be seen. There are a lot of moving parts here. There's still several $1 trillion after we pumped in $5 or $6 trillion in the last year. There's still a couple of more trillion that hasn't really been applied yet. And you're seeing some strange outcomes, things like putting $450 billion back into state aid, and then a state like California has a $75 billion surplus. And so I think we have to see how some of these things play out before we're really going to be able to predict what the future looks like. I think one thing we know for sure, consumers are starting to open their wallets. As the economy reopens further, more of these restrictions get lifted. We see people resuming their pre-pandemic behaviors. I think we're in for a blockbuster summer, and it's going to be exciting to see how retailers continue to serve those customers, take care of their team members, and help drive our economy forward.
Matthew, it's one thing to have to pay some more for some of the inputs, whether you can pass along or not. It's another thing if you just can't get the inputs at all. I mean, we're seeing it, for example, in semiconductors right now in the auto industry. Are you seeing in retail just some total breakdowns of some supply chains?
Well, I think, when the stories get written and the case studies get written a decade or maybe in a couple of years from now, on the way retailers in particular responded, kept the economy moving, kept those distribution centers open, worked through their supply chain challenges. I think we saw the supply chain bend last year, but sitting here today, it's hard now to recall the remarkable work that those millions of retail employees did to keep our communities running. And when many of us were locked in our homes for weeks at a time, afraid to go out, fearful of what we didn't know about the pandemic, the retail industry was on the front lines there. And I think what we're seeing now is the rebound of the supply chain. Retailers obviously worked with their partners, learned an enormous amount last year, had the opportunity. We saw a great holiday season. We've seen the last couple of months of amazing performance in terms of retail sales. Our forecast for this year is 6.5% to 8.5% growth. And we feel very confident we're on track to meet that based on consumer behavior and based on the overall strength of the economy.
I think all of us are happy to be able to go back out to the store again. Thank you so much to Matthew Shay. He is president and CEO of the National Retail Federation. Coming up, we're going to hear from the Discovery and AT&T CEOs on their big deal, what led to it, and what comes next. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Yesterday, Discovery and AT&T announced their huge media deal in which Discovery will merge with the spun-off media assets of AT&T, creating a new company worth about $130 billion in market cap. I spoke with the CEOs of the two firms, asking about the changes in direction this represents for both of them, starting with Discovery CEO David Zaslav and his decision to move into scripted, high-cost entertainment programming.
In many ways, we're really in the same business. We're both global IP companies. And we've been on a mission to aggregate more compelling stories and characters and IP in the U.S., which is why we did the Scripps deal with HG and Food, and why we got into business with Oprah and Chip and Jo. And so, you know, even though our content may be less expensive, we still aggregate to about 20 to 25% of viewership, depending on any given night in the U.S. And outside the U.S., we're the leader in sports in Europe with Eurosport, and we have free-to-air channels in a number of markets where we're like NBC or CBS, as well as being in the cable nonfiction business. But John and I are really aligned in strategically trying to get to scale above the globe, to be a meaningful, scaled competitor. And in order to do that, you need great content that people love. And one of the things that we looked at, we launched Discovery Plus, very strong, great product, great reviews and app ratings, and people are using the product for 3 hours a day. But we looked at what John has, King Kong, Godzilla, the incredible brand of HBO, Sex and the City, Game of Thrones, Superman, Batman, and we started to think about it as a combustible combination. You got some incredible IP that people will pay for before they'll pay for dinner. And then we have a bigger library than Netflix with content that people love, whether it's Oprah or Chip and Jo or Food Network or HG or the BBC content, Planet Earth. And so I think this is just a way that kind of assures that Warner, probably the top of the pyramid in quality IP and quality talent that's loved all around the world, together with the content that we have, where we are already the largest global media company. We have more global IP than anyone else, and when we come together, we think it makes us a real formidable global IP business to compete with the best in the business.
So John, David says that you're at least in the same sort of business, even if they're different ends of the business. But you've also had something of a change of heart here. There was a major strategic decision made to really move into the media business as a telephone company. And now you're really reversing that. You're going to go back to your roots, the telephone company. Let me understand. Looking back at it now, was the strategy wrong, or did something change in between? Because let's be frank, you're leaving some money on the table. There is some value being destroyed.
Well, I probably dispute whether or not there's value being destroyed. I'd actually say that we've managed to increase the value of the assets we bought by maybe about 30%. If you look at the cash we've taken out of the business, the assets we sold, and the effective value of this transaction, and some reasonable assumptions of once it trades as to how it's going to trade at a multiple.
John, I just want to make sure I understand that. I think you bought it at $85 billion. This is $43 billion. Are you saying you got that difference out in cash?
Well, we're getting $43 billion in cash, and we're getting 71% of the equity of the new business. So there's two parts to that. And the point of view that I think I'd have on this is the team's done a remarkable job of pivoting the asset to be effective in the direct-to-consumer world, and that's really the value that I think David and the rest of the industry see it right now. Now, what changed since we went into this was originally a point of view that this would help our connectivity business, and indeed it has. It's lowered churn, It's helped us on customer acquisition, on things like selling more broadband connections, and it's raised customer satisfaction on those products. But in 2016, I don't think we had a clear picture of what the global opportunity was going to be in direct-to-consumer and whether or not that was going to be essential to playing in that space. And it's become clear that, as David just described, it's in fact going to be global. And the market opportunity for that, the value creation opportunity, is significant. It's so much more significant than the value that we get back into our connectivity business domestically in the United States to drive down churn and improve our customer acquisition, that I can't in good conscience not allow these assets to develop to their full potential and to give it the kind of exposure in the market that it needs, to get the kind of multiple on it that we just talked about that will increase value that the share owners of AT&T at 71% will carry forward. This is the right move at this time to actually make that happen, given the changes in the environment.
So, David, the opportunity, David, really is that by putting our assets together in media, we think that we're not just better together, but that we're probably the best media company in the world. We have the most IP, we have the most in-language content, we have the greatest diversity of content, and for John, the vision here is that 2 years from now, 3 years from now, 5 years from now, we're the #1 media company in the world, and AT&T is the #1 telecom communications company in the world. And we take along 70% of our shareholders are John's shareholders, and we're creating value for them if this, if we can do everything we think we can.
That was part of my interview with Discovery CEO David Zaslav and AT&T CEO John Stankey. Coming up, New Jersey wins the prize for highest taxes to be paid over a lifetime. We talk about that and the tax competition among the states with Bloomberg's Laura Davison. This is Balance of Power on Bloomberg Television and Radio. This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. A new study says that people in New Jersey will pay the most in total taxes over their lifetimes, over $900,000 in total, followed by Massachusetts and Connecticut. When I talked recently to New Jersey Governor Phil Murphy, he said that you pretty much get what you pay for, and New Jersey is overall still a good deal.
The space we occupy is that moniker, which we don't take lightly, America's #1 state to raise a family. We have the #1 public education system in America, top handful of healthcare system, a location second to none. We're fixing transit. The quality of life is exceedingly high. I'm proud of the values that we have, whether it's gun safety or women's reproductive rights, you name it. So that's our value proposition.
To take us through the study and the competition among the states over taxes, we welcome now Laura Davison, who covers Congress and taxes for Bloomberg in Washington. So, Laura, welcome. You've written several articles on this so far. Let's talk about that competition, because some of the states, like New Jersey now, are saying, wow, we're really getting hurt by that SALT, state and local tax limitation, and it's driving some people to move away, despite what Governor Murphy just said.
Yes, this is something that the northeastern states, the high tax states, are proud of all the social services that they provide, but they're seeing that some residents don't want to pay those high income taxes, the high real estate taxes, so they're opting for, low tax states like Florida, Texas, and particularly what they're worried about is the very high income people moving to those states, because the really high income folks are the ones who are funding a good chunk of those social services, the education, the transportation that Murphy talked about. And this is really at the heart of the whole SALT debate in Congress. You have about more than 20 Democrats who are largely from New York, New Jersey, California, who say we want to restore the full SALT deduction, which Trump limited back in 2017, said you could only deduct $10,000. And for lots of residents of those states, they have SALT bills that are way larger. So they said, look, we want to support Biden's infrastructure plan, but we won't do that unless we also talk about expanding the SALT deduction.
Yeah, at the same time, you cover Capitol Hill. Is there any likelihood this will actually get eliminated, the SALT deduction?
This is going to be a key negotiating point going forward. It is likely that, SALT is expanded. I don't know if they're going to bring back the full deduction, but this is something that Biden will have to work with if he wants to get his agenda through, but they're going to have to find a way to pay for it. So that means either cutting some of the infrastructure spending or finding other tax increases, which also won't be easy.
It's a fascinating subject, particularly for those of us in the Northeast. Thank you so much to Bloomberg's Laura Davison. Coming up, we'll have a second hour of Balance of Power on Bloomberg Radio. This is Balance of Power on Bloomberg Television and Radio.